Let's break down the step-by-step rules. I gave you the overview in the previous lecture, which showed you the benefits and some winning trades and how simple it can be. Now let's break it down step by step so you can really get to follow it piece by piece by piece. Okay, first we draw a line to represent the average price for, let's say, the last 9 to 12 hours. Draw a line above which, for much of the time, the market was below it, and a line around which the market tended to trade. We expect pullbacks to the line when the price goes above it too far and too far below it. That's what happens. So, what are the rules? Well, I find an overshoot. In other words, the price goes more than 3 times the average true range. Most pieces of software will show you what the average true range is. The average true range is basically the range the price moves each day, just as general movements, on average, let's say over the last 15 periods average, each day or each period how much it's moved, and multiplied by 3 times the average true range. We go short at that point if it overshoots it. What is, or long, depending on which direction it's gone for mean reversion. So what is the average true range? As I mentioned, it is, let's say you're looking at the 5-minute bar chart, the average true range. Average means the average of a certain number of periods, let's say the last 15 5-minute bars, and it's going to be a moving average, obviously, because that period's going to change. So that's the average and the true range. The range is then multiplied by 3 to give us an idea of how far it's moved across. Okay, all trades, as mentioned, come in, all the kind of trades that I've mentioned come in 2 flavors. The straight win, where it's extended. So this was the average, the moving average of the price, and this is 3 times the average true range. And you can see it moves, of course, because now I'd normally do this by eye. I've just drawn it here on a computer system for you. Okay. When it extends too far, you buy at that signal and the price moves straight away in your direction. Mean reverts. Those are the simple, easy ones, aren't they? Those are the simple, easy ones. The other ones are where you do that, and of course it moves against you before going back to the mean reversion. That's like most trades for most people. And you can see there it's made a 1-period low. So since we entered around this green arrow, that means a 1-period low, i.e. it's lower than the previous 1 period. That's a 2-period low, lower than the previous 2 periods. And that's a 3-period low. And so it's gone down quite a bit. That's the kind of trade where we probably would have just stopped out and regretted it. But that's the way it is. Better to stop out and regret than go the other way. Okay? When do we take a profit? When do we take a profit? You've got 2 choices. Let's say you entered here. You can either take it when the price reverts back to the average, or when it overshoots to the other end and overextends to be at 3 times the average true range away. That's when you can take it. It doesn't have to be scientific, remember. Normally, this average true range line, I would tend to pick by eye. Okay, but you can have software to draw it for you, but you get the principle of pullback on every occasion. Because trades come in 2 flavors, obviously we want them all to be just in one direction. Sadly, life isn't that simple, and like most of our trades, we often enter and sometimes we just lose, because although it does come back, it dropped too far and we didn't want to risk it. We didn't simply want to risk it. Here's another example. 50 pips, $50 a pip, $2,500 in 5 days in this occasion. It was a 4-hour. Each one of these bars is 4 hours. And it's sterling dollar. Okay. And it drops back to the mean reversion. Why is my system so effective? Why do you get so many winning trades? Well, triple filtered. Let me explain what I mean by triple filtered. MVP is what I call it. Reason 1, it's based on price momentum. As I explained, prices move in a certain momentum and then they follow through on that. It's based on value. Prices are trading around value. We know that. It's also based on psychology, as I explained. The psychology of trading is people undershoot and overshoot. That's why it's so good, because it's based on momentum, value, and psychology, and it's why it keeps winning. Most of you are probably worried about the average true range. How do you notice it? You either use your broker software, or as I do, just look at it by eye. Has it reverted too far away from the mean? And the mean price is simply, in my case, a 15 or 30 period moving average of the trade, of the prices that we're trading, whether it's a 5-minute bar or a 1-minute bar. And very often I will put orders in the market and just leave them. So I'll say, sell short at this point and exit at this point. I particularly like it when the moving average price is moving sideways and is just fairly flat. You can see here the price is actually trending lower and it's trading around that. But I like it when it's just moving sideways, because then I know, well, if that continues, I can just put orders in to sell there and to buy back there, and so on. And some of them will get executed at profits, others just won't get executed at all. But there'll be more about trading orders and simplifying your life and not being stuck in front of the screen in the next module. But the next lecture I'm going to give in this module will be, again, more examples of how much profit we can actually